It's already been confirmed that we have an unemployment recession. According to the Bureau of Labor Statistics and the report for July, payrolls and employment, the unemployment rate jumped by another 0.2% to 4.3, strongly implying the US economy has indeed finally met its point of full-blown recession. Everything has been weak since last September and October, and since then, it seemed like the economy was hanging in. So you can understand why people were talking about soft landings, though the no landing was probably a little bit too aggressive, a little bit too clickbait. But essentially, a soft landing seemed like it was a decent possibility. But that was just consistent with the historical pattern, where the economy starts to fall off and it doesn't do it right away. Unemployment in particular goes sideways and kind of meanders a little bit higher, which gives rise to this constant repeating cycle of soft landing predictions every single time. And every single time we see this time is not different. So, according to the Bureau of Labor Statistics, the unemployment rate jumped to 4.3%, and that's not going to be the highest number for it. The underemployment rate, the U6 number, jumped to 7.8%. That's up 0.8 of a percentage point just since November. So large moves in underemployment and unemployment. We've got jobless claims that surge, both initial as well as continued claims. A whole bunch of labor indications suggesting not just an unemployment recession, but eventually a full-blown GDP recession as well. So Steve, Mr. Van Meter, we've got rising unemployment, we've got rising underemployment. That suggests, especially massive moves in the marketplace, that we've got a recession developing, leading to probably a series of rate cuts. And even the stock market now is suggesting, or at least afraid of, this growth scare.
Yeah, Jeff, and they're all connected. And that's the beautiful thing about this is there's really no surprise to what's happening here, except to all the people who thought the soft landing narrative was real. And you kind of get the perspective of why consumers wanted to buy into it, because they really didn't have a choice. They took a lot of debt on when consumer prices rose and their incomes didn't. They're behind the curve. Their expenses are going up. The economy's slowing, and they're just not in a good position because they've already drained down their savings. So you think about if that's your situation going into a recession, it leaves you with, well, no margin for error. As we kind of like to say, no skid marks as the car hits the wall. So consumers had to buy into this. And the problem is it's not happening at all. And so as we saw today in the non-farm payroll report, 114,000 jobs, that didn't look too great. The unemployment rate went up past Fed Chair Powell's target. Of course, we know he'll fudge it to say that was approximately what he was referring to, but it's still going the wrong direction. And that's the problem here is we were told this was supposed to be a second half rebound. Now, will we continue to hear from the Fed, in the coming weeks and the speakers come out and say, well, it just happened a little later than we thought, but this is the bottom? We don't know. But the data right now is getting pretty clear that things are going to get far worse than they are now, and that this is only the beginning.
Yeah, it's not just the macroeconomic statistics like the unemployment rate. First of all, we've got, as you just mentioned, the payroll, the headline number. You and I were joking before we started. We kind of thought it would be 350. We were actually surprised it was as low as it was because it has been, unconnected to basically anything in the economy for a long period of time anyway. So it was like, okay, 350, 375. Let's see if it hits 400. And to come in at 114,000, that was one of the reasons why the market had such a powerful reaction, because that was one of the last holdouts. Pretty much everything else suggested, recession is coming. And a lot more recently has suggested the recession is actually here, which is what the unemployment rate is doing. And now here we have the payroll report at 114,000. And you and I both know it's not actually 114. It's very likely to be revised for a couple of reasons. We'll have the preliminary revision next month, as well as the benchmark revision, which we already know payrolls have been overstated for quite a long period of time. We'll see what the QCW says. But it's not 114,000. There's a very good chance that the July payroll, the real number, was probably negative. So you throw that on top of everything else. That's why markets are making an aggressive move, because they're looking at the data is confirming everything that they've been pricing for a very long period of time leading up to this. And of course, as you said, Steve, Mr. Powell and all the Fed speakers are going to downplay everything and say, well, yes, the unemployment rate's up, but it's still low. And as you just pointed out, it's not about the fact that it's 4.3%. It's that it was 3.8% not all that long ago. And now that it's 4.3%, you can see where the trajectory is going. So as the unemployment rate rises, we know where interest rates are going. And it also tells us something about maybe where stocks are going to go too.
Yeah, absolutely, Jeff. Because one of the things that I love, one of my favorite data series has to be the continued unemployment claims, because that really tells us everything. Tells us where initial claims are likely to go. But here's a beautiful part: the U6 follows it with or the unemployment rate follows it with a lag, which of course the non-farm payroll follows that with a lag. When the consumer price index follows that with a lag. So if you want to know where things are going, just simply look at the weekly continued unemployment claims, and it gives you a pretty good idea. And as you said, the stock market's finally starting to come to this reality that all this soft survey data that we've been seeing out of the ISM, S&P Global, and the Fed is suggesting that, hey, things aren't that good. But the non-farm payroll report continued to say, well, we know what the surveys say, but look at the real data. And now all of a sudden the real data is saying, wait a minute, maybe something is wrong here. And that means, of course, the U.S. stock market and the economy aren't just headed into recession. As you said, we're already in the early stages of it. And that's what's really dangerous here, because no one actually bought into that narrative. And now it's starting to come true at a time when we know that August is a terrible month for equities. Usually money flows out. Now all of a sudden you have fears that the market's going to go down. You have the natural sellers of this time of the year. And what I think we're going to hear from the Fed speakers in the coming weeks, Jeff, is, yeah, summer was a little slow, but we thought that was going to happen. But wait till school gets back into session, because so many of these jobs are going to come flooding back. Everything will be okay. That's my prediction.
I think that's what they're going to start out with, and that'll last up until the point where they actually have to start thinking about cutting rates. And then they'll say, well, we're just cutting rates just to make sure, assuming assuming they're able to do that, because some of these markets, especially forward rates markets like term SOFR futures, suggest that even the markets are starting to bet that the first move out of the Fed isn't just, hey, maybe in September we might do a 25. The marketplace is looking at maybe an intermediate rate cut. And I think, that's not out of the question, because I really believe that Jay Powell would have cut last week if he had the opportunity to do so. I think he was trying to placate the narrowing group of permahawks on the committee that just always see inflation pressures in anything. And so he didn't cut last week, but he did come out at his press conference and say, yeah, I can imagine a series of rate cuts, which is exactly what the market's pricing. And the market's pricing that not because Jay Powell said it or Jay Powell's going to do it, but because that's the economic situation that we're actually looking at. That as the recession starts and the unemployment rate continues to move up, the Fed is going to end up chasing it. And when you put these markets together, as I did in yesterday's video, what they're really saying is that it's already too late. And by the time the Fed does get started, it's going to have to try to catch up, which means maybe an intermediate cut, though that's probably a smaller possibility. More likely a 50 basis point rate cut to start in September, which, by the way, is exactly what the Fed did in September of 2007. The first one was a 50. And back in January of 2001, the start of the dot-com cycle, the Alan Greenspan's Fed did not just 150, but I believe it was 4 or 5 in succession. So what does the economy look like where we go from Jay Powell today, well, maybe not Mr. Powell, but the committee in general saying it's just a minor slowdown, to suddenly we're talking about 50 basis points in succession? What does the economy look like under those circumstances?
Yeah, that's a really good question, Jeff, because coming to September, I don't think it's going to look very good unless there's a big change in the labor market. And so far, none of the data really suggests that this is a soft landing, because we can look at the surveys, and if they were more consistent with, hey, you know what, we're seeing an increase in new orders, or we're getting calls about new orders, something to suggest that, yes, there's a change here. But instead, we look at the surveys, and what do we see? New orders dropping off at massive rates, backlogs dropping off at huge rates. But I think the problem for Powell is he dug his own hole, because he told people that, hey, we're going to go, not to where monetary policy needs to be. We're going to go into a restrictive zone. We're really slamming on the brakes here. And he set that up so he could pull back a couple cuts at some point and say, see, look, this is exactly what I wanted. But if he steps out now between now and September meeting, has some emergency intermeeting cut, I think that tips the market off that something's seriously wrong, and he knows it, and he can't do it because that means that he's been wrong this entire time. Of course, we know, Jeff, no Fed chief wants to admit that ever, even though their track record is perfectly flawed. So you're right. I think he's got to wait till September. Things are going to go look worse. He's going to have to do a 50 basis point cut. And as we know, as you just said, it's the first of what will be many because the Fed's already late to the cycle. And this is really simple. You can just look at a chart of the unemployment rate against the funds rate, and you'll find out there's always a lag. In fact, over time, the Fed gets more behind and more behind. And the gap now between this being September suggests it's game over for the Fed.
Yeah, once the rate cuts start, they always have to try to catch up because interest rate cuts don't work, they don't do anything, that they always just have to keep chasing. As the unemployment rate goes higher, they have to keep going lower.
Wait, Jeff. What do you mean they don't work? It's just a long and variable lag. We know this. We just don't know how long or how variable. So it just takes time, but they're magical.
No, it's, the funny thing is, and we were talking about this before the show too, is that the Fed says their rate hikes take a long time to work before they start to depress the economy enough to do whatever it is the rate hikes are supposed to do. But when they're faced with weakness in the economy, they start cutting rates. Everybody talks about it. There's no lag at all. The rate cut starts and everybody's just happy and cheerful. And we know this is, you get the sense that this is all just made up nonsense because it actually is made up nonsense. And what we're actually looking at for rate cuts, what they really do is they just confirm that the situation has gotten to be so bad that even Jay Powell can't say with a straight face and maintain any credibility whatsoever that everything's just fine and it's soft landing. And we know, we've had any number of indications, not just in the payroll reports and the labor market data. Companies all over the economy have been telling us over the last several months, this is not going well. We don't see our customers show up as much as they used to. And when they do show up, they don't have any money. There was a report just on Friday from the CEO and the CFO from Wayfair, and they compared this to 2007 and 2008. This is where the GDP recession comment comes in. What the CFO, Kate Gulliver, said was, we see declines that are similar to the declines that we saw in the 2008 to 2010 period. And I think what that speaks to is that the category has been going through just a massive correction, a correction that we previously only seen during a GDP recession. And isn't that interesting how quickly the GDP, the second quarter GDP number just faded from everybody's screens? It just disappeared because everybody knows, first of all, it was overstated to begin with. And second of all, it has been overtaken by everything. The markets, even the stock market. Now we've got the unemployment rate going up, and even the payroll report missed badly. It's very clear that the economy is in a bad way, and Jay Powell is not going to be able to rescue it.
No, he's not. And history shows that he can't even if he wanted to. And that's what's kind of interesting about this. A lot of people have this belief in the magical power of the Fed and interest rate cuts. And yet, Jeff, as you and I know, you can take, any chart you like, whether it's the unemployment rate, non-farm payrolls, continued unemployment claims, pick a chart and then overlay the federal funds rate. And what you find out is a couple rate cuts really don't do anything because by the time the economy starts slowing down, and I want people to think about this, as someone goes on unemployment and they can't find another job, maybe initially they, run up their credit cards or spend down their savings because they turn on the news and they hear, the Fed chief say, hey, don't worry, this is a soft landing. Everything's going to be okay. You'll get a job. Don't worry about it. And so next thing you know, they're not back at work. So their spending has to go down. And that starts to slowly backfeed into the economy, meaning someone else, because their company's not doing enough business, their hours get cut, jobs get cut, they go into the employment line. And starts to stack up until it snowballs out of control. The reality is you can go cut a quarter basis point all you want, or 50, or cut a whole percent. Does it mean the fact that Wendy said our foot traffic is down? Does that mean as soon as they cut, rates, that people go like, oh man, I'm going to go out and buy a hamburger? It's not going to happen because nobody actually knows it or feels it. And that's the challenge here is the Fed wants everyone to believe there's this instantaneous response. Hey, look, we cut, go spend. The problem is people don't have any money. Savings rates are depleted. Credit card rates are outrageous. We know limits are maxed out. We know debt service costs are high. We know consumer prices have gone up. And this puts the average American household in a very dangerous position with no money to spend.
Yeah, what most of these people are going to be looking at is the fact that layoffs are coming, job cuts are coming, more hours are being cut, worsening conditions in the labor market than we've already experienced. So when Jay Powell gets on TV, likely in September, and says, I cut by 50 basis points, there'll be a lot of people in the financial media cheering this aggressive move from the Fed and how powerful it is. Well, most people are just going to be looking at their situation saying, this does not look good, and it's only getting worse. And you said a couple rate cuts don't work, Stevie. You know, no rate cuts work. None of them. You could do a whole series of them. I mean, look at 2001. Alan Greenspan's Fed dropped interest rates by 5 percentage points from beginning to end, and we had a recession anyway. Not only do we have a recession, the unemployment rate continued to rise years after the recession ended, despite the fact that rates were so incredibly low, all that kind of stimulus. Rate cuts don't mean anything. So we look at the markets making an aggressive move here, interest rates falling pretty sharply, forward rates falling even more sharply, and swap spreads looking at the long run. What they basically tell us is that what we're seeing here, as you just said, Steve, is just the opening stage. And I know we've been saying this for a long time and we've been building toward this for a long time, but that's what nonlinearity is all about. It starts off really slow, almost imperceptible, and then it gets a little bit more, and then all of a sudden, it's just some unknowable, unpredictable point. Everybody's like, "Oh, okay, it really was bad," but it's been moving in this direction the entire time. It was almost inevitable that we were going to get here, and now that we are here, forget about the Fed, forget about rate cuts, start focusing on what the macroeconomic conditions are going to look like, and start listening to the markets about what they could potentially tell us about what this what's near term ends up being.
Well, near term is very dangerous, Jeff, because what have we noticed? Delinquency rates have been rising. That's been a problem. It's not just the labor market itself, but just balance sheets for households in an absolutely dangerous position. Fed now potentially on the shelf until September. And again, not that it matters, but perhaps it matters to market participants. You mentioned kind of what does the average consumer feel, and they don't. But there's only one thing they do, and that is eventually credit card rates do follow the funds rate. But the problem is it's not instant. It's usually with a couple month lag. And realistically, how much is that going to free up a household budget if the Fed cuts 50 basis points and the interest rate on the credit card comes down a little bit? Saving a few bucks a month is not going to change the picture here. And that's what's dangerous. If we do not see a big surge back in hiring here in the months to come, like the soft landing narrative is supposed to suggest, or a big increase in new orders come into factories, which at the moment we have no indication of that. As I said, the fax machine is not ringing right now. But anyways, it just puts us in a position where by September, the U.S. economy is going to look far worse. The stock market far worse. Does it mean that interest rates won't follow their seasonal path through August and September and have some sort of rebound and go higher? I think it's likely, but after that, watch for them to head significantly lower.
Yeah, now that this thing is here, it's time to turn our attention to, okay, how bad will it get? And as you just said, there's lots of negative signals, and we haven't even seen a real spike in unemployment. I've said all along that the markets were telling us the 2020s were going to look like the 2010s. And it was the swap market that told us most of all and what to expect for treasury yields as they start to move in that direction. That's the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.